An important aspect of traditional futures contracts is the expiration date, where contracts expire and the settlement process starts. Futures contracts often settle on a monthly or quarterly basis, and the contract price converges with the spot price as positions are closed. In crypto, however, there are perpetual contracts offered by CEXs and DEXs. Unlike traditional futures contracts, perpetual futures contracts do not have a settlement process, allowing traders to hold positions indefinitely. So instead of relying on settlement, perpetual contracts converge with its underlying spot price through the funding rate. Funding rates, or funding for short, are periodic payments, for example every 8 hours, paid to or by traders who are holding a position on perpetual contracts. It's designed to be an arbitrage mechanism that incentivizes traders to keep the contract price in line with its spot price. It's essentially the cost of holding a perpetual contract and is calculated based on the difference between the price of the contract and its underlying spot price. If funding is positive, it indicates that the contract price is trading above its spot price. Long positions will therefore be more expensive, as traders going long have to pay the counterparties which are shorting to hold their position. Conversely, funding is negative when the contract price is trading lower than its spot price. Shorts in this case will pay funding to longs to keep their position open. The bigger the difference between the contract price and its spot price, the more extreme the funding rate. This mechanism encourages traders to bring the contract price in line with spot price. For example, if the funding rate is highly positive, it means that a contract is trading significantly higher than its underlying spot price. Traders can take advantage of the arbitrage opportunity by buying the coin in spot, then simultaneously short the contract and collect the funding rate from long positions without directional exposure. When examining funding rates, it's helpful to look for divergences between funding rate and price. High positive funding rate when the market is on a downtrend indicates that bulls are being squeezed. This is bearish. High negative funding rate during an uptrend could mean that bears are being squeezed. This is bullish. If funding rate becomes more positive as price goes lower, this indicates aggressive perp buyers or big spot selling. Conversely, if the funding rate becomes more negative as price goes higher, this indicates aggressive short interest or big spot buys. Funding rate can also be used in conjunction with open interest to quantify the amount of aggression in the market. For example, when open interest and funding rate sharply increases, it indicates buyers aggressively going long on futures. Conversely, falling open interest with decreasing funding rate indicates buyers exiting their long positions. There are, however, certain caveats when it comes to using indicators to analyze the market, so it's important to combine indicators or tools to provide a more nuanced view of the market rather than in isolation. If you'd like to study the funding rate on your own, check out Coinalyze or CoinGlass. These free websites provide charts with a good view on funding rates and open interest on most perpetual futures markets. Speaking of open interest, check out our previous video to learn more about that.